Okay, so welcome back. So earlier we talked about fair value. So fair value is like how we compute under IFRS 13. Okay, so that was yesterday's class. Now we have what we call amortized costs. Okay, so for amortized costs, this is what we call an amortization table, or sometimes people would refer to it as a present value table. So this is something that we always use. We use the Excel function to help us to compute this table. And to illustrate how do we do an amortized cost. So let's say if I have a financial asset that is carried at amortized cost, this is the figures that I expect to plot into my financial statement on a year-to-year basis. Okay, so let's look at one example. Company A purchased a bond with a 5-year remaining to maturity for its fair value of ringgit 1,000, including transaction costs. The instrument has a principal amount of 1,250. So this 1,250 basically eventually at the end of the maturity period, I need to pay because that is the principal amount. And this instrument carries a fixed interest of 4.7 that is paid annually. So this 4.7 is the contractual rate. So when I look at my contract, the contract will say you pay 4.7% of the principal amount on a year-to-year basis. Okay. Company A intends to hold the instrument until maturity. Okay, so if I were to present it in a formula base to determine what would be the opening present value figure and how it would zero-rise at the end of the 5-year tenure, this is the formula. Okay, so my initial value is equivalent to the cash flow of each year, and it is divided by 1 plus the rate, and the rate being the effective interest rate. So contractual rate of 4.7 is not necessarily an EIR. Okay, so effective interest rate, EIR. So EIR, if I were to compute it for this, is actually 10%, not 4.7. Okay, now the 4.7 will only tell you how much of cash that I need to pay. So if I plot it in the table, so imagine this is an Excel file, yeah? This is the year. So I initially recognized in this year opening at 1,000 because this is the fair value of the instrument on initial recognition. Then interest income that will go into the P&L, which is credit my interest income and I debit my financial asset, is based on an EIR rate of 10%. Because that is what IFRS 9 says. It says you do a charge to the income statement, the interest, based on an EIR rate. Okay. So what does EIR mean? It actually means that it is a consistent rate throughout the entire period. Okay, and if you look at here the cash flow stream, this is based on your contract. So how much do I need to receive in terms of this bond? I get 4.7% of 1,250 because that's what the contract say to determine the cash flow. So I have 59 for 5 years, and in the last year, I will receive back the principal amount. That is pure cash flow, okay? Then this would represent your closing balance of the financial asset. So in the balance sheet for 20x0, initial recognized at fair value 1,000. I add 100 and credit interest income based on EIR. I receive the money, so I would credit this financial asset and debit my cash. and my closing balance for the financial asset becomes 1041 as of end of 20x0. Then I will do the same every year. So end of 20x1, I will get 106 sitting in my balance sheet. And in my P&L, I will have charge interest income of 104. Okay? Then at the end of year 5, after I receive all the interest and charge all the interest and I receive all my money, derecognized already. It's fully matured. I got back everything. Yeah. So this is going to be very common in all your amortized costs, especially long-term related financial receivable, finance assets that is carried at amortized cost. So you don't see this for a typical trade receivable because it's short-term in nature, okay? And normally there is no contractual interest that you charge unless you really do charge your customers for like late payment interest, or you do charge on a periodic basis if you are asking for deferred installment. Okay, so we go back to Menti, okay? So yesterday we played some game, right? And this will be the same. This will be the same number, the code. Can you type the number in the chat for those online? Yeah, just in case. Okay, so the code is 74197865. So this is the question. So we want to check, do we understand the principles of business model and contractual cash flow, or whether do we have enough information in the question for us to decide what classification? Okay, so for corporate bond, the entity holds a corporate bond with a duration of 5 years and is repayable at the end of the period at par. Interest is payable annually in arrears at fixed rate of 5.5%. There is no repayment or extension option that is associated with this bond, and corporate bond held for collecting their cash flow. The sale of bonds to manage the business cash flow is also an integral part of the model. So what do you think is the appropriate classification for this corporate bond under IFRS 9? So we have to ask ourselves 2 questions. What is the business model here? And does it meet the SPPI test? Oh, so little people. Only 17 answered. Yeah. Okay, shall we just proceed? Okay, so the answer is B. Okay, B, boy. So it's actually a fair value to our OCI. So if we go back to Y, this is the recap. What is the business model in the fact pattern? It is held to collect and sell. Okay, if you happen to miss that, let me show you where. Okay, here it says the bond is held to collect its cash flow, but it also say the sale of the bond to manage the business cash flow is integral part of the model, means it's quite important. Then is also and sell. If it says incidental, then it would have been held to collect only. Okay, so this one, the terminology quite specific. So of course in real life, they won't use terms like this lah. They will tell you clearly, right? So they will tell us very clearly what is their business model. So from here, I will have held to collect and sell. It would meet the contractual cash flow characteristic test of SPPI, because for the bond, you have that interest of 5.5%, plus you have the principal amount. So it will go down to fair value to OCI category. Okay? Now let's look at the next question. Entity B holds a convertible bond. The convertible bond carries annual interest cash flow of 6%. Further, it may be converted at the option of the holder, which is entity B, into a fixed number of equity instrument of the issuer. What is the appropriate classification?
Mayin, could you please back the previous slide to show the Menti code?
Oh, you want to see this?
The Menti code?
Oh, Menti code. Hang on. Yeah, 74197865.
Yeah, thank you.
Yeah, maybe that's why very few answer. The code is not available. Okay, I put back the question so that it's bigger. Okay. So once you reach 50 responses, then we share the answer. Okay. Okay, the answer is A. Okay. So let's look at the fact pattern and then which category. So it is non-SPPI. So once you fail non-SPPI, doesn't matter what's your business model. You can never go into this classification here. You only have one option, fair value to P&L. So where is the part that failed the SPPI? is the convertibility of the instrument. When you introduce an equity conversion feature, the underlying is based on price of the equity instrument. They are not like normal basic lending arrangement. So fail SPPI. Okay? So this is a recap. Convertible loan. So is bonds are like loan. If it's normal corporate bond, right? So I also saw a question online asked, what do I do with government bond? If it's a bond, it's like corporate bond or a loan. If it meets SPPI test, then you can see it in amortized cost if it's held to collect, or held to collect and sell, then it will be fair value to OCI. If it's a convertible bond, so there is a feature of a debt instrument, but there is also a conversion to equity, it will not meet the SPPI test, because whether or not I will exercise my right to convert to shares depends on the share is good or not, right? Because if the company is not doing well, I don't want the shares, I want the money. Okay, so it's not like any loan. So it will fail SPPI test, and you have no choice but to account for it at fair value to P&L. Okay, another one. Entity C is a manufacturer which sells goods on a 45-day credit term. As of December 2020, the trade receivable stood at 2.5 million. What is the possible measurement for this? So if you notice in your Menti, your boxes are not a round radio button. It is box. So you can have multiple choice. Okay? So the answer is all of the above. So we might look at it very simplistically. Trade receivable definitely is amortized cost, right? But if we follow the IFRS 9, okay, you can have any. Because at the moment, I did not give you the information about what is his business model. But I know that the SPPI test is met. Okay? So if the client or the preparer is actually deciding to hold the receivable to collect it in full, then it's amortized cost. If it decides to hold to collect some, and some it will sell, then it will be fair value to OCI. If it is neither of these two, it becomes fair value to P&L. If it wants to designate on initial recognition to fair value to P&L, he can also do so. So it goes under fair value option to fair value to P&L. And this one is irrevocable. So trade receivable, very rare I see companies would account for as fair value to P&L. But you can do that as well. Just that every year, you have to go and re-measure what is the expected fair value of that trade receivable. The mic?
You said that SPPI is met.
Yeah.
It means that because the question doesn't tell that it have the interest element or not in when they provide the credit. So if then does we if on real life we don't have any interest element embedded in that instrument, can we say that SPPI is met?
You can. So not having an interest charge may actually still have what we call SPPI test met, because it really depends on the circumstance, right? So if you look at this trade receivable, it didn't say that it is due in the next 5 years and I don't charge you interest, right? So to a certain extent, if we say that the 45 days credit term would not have attract a significant amount of interest, it will still be met, because if you imagine this is an actual loan for 45 days, you might not actually even have much interest at all. So normally, if it's short term in nature, even if there's no interest and you're going to recover the principal amount, it will meet the SPPI test. Unless we are saying that it's possible that you will only get 1 million, for example, contractually, you're exposed to that. So there's a downside to it. But contractually, your right is 2.5 is okay. If contractually your right can be below it, then it might not meet SPPI test. And that doesn't, we shouldn't confuse that with ECL, because ECL still go back to your contract says you are entitled 2.5, just that they are unable to pay you 2.5 as ECL. Yeah. Okay, next one. So if you have debt factoring, so entity D here is a trading entity and it sells goods on the 90-day credit term. As of December 2020, 1st December, the receivable is 5.5 million. And entity D is considering to enter into a debt factoring scheme with the bank for some of its trade receivable. Okay, debt factoring means you sell your uncollected invoice. Okay, so what they do is you sell the invoice to the bank will collect the money from the customer, the invoice, but they will pay you cash, right? Which could be less than the amount that is outstanding in the invoice, because the bank needs to make profit out of it, right? Okay. So the debt factoring scheme is without recourse and will achieve derecognition under IFRS 9. Okay. Without recourse means if the bank cannot collect it, it is its risk. It won't come back to the entity D and say, this one I cannot collect. Now I pass it back to you. Then that risk stays with entity. So there's a difference between without recourse means the other party will bear the risk. If it's with recourse, means entity D will take back that risk. And here they want to clearly say, the without recourse, because all the risks will transfer out already, right? It will achieve derecognition. So we are saying this financial asset will remove off the books once I debt factor in, okay? So what is the possible measurement classification for the trade receivable that will be factored to the bank under IFRS 9? So the D is there to confuse you. Okay, any more response? Very few. Okay, let's look at the answer. So generally, for accounting, I always think it depends is very common because two lines of words will not explain everything, right? So let's see what do we consider, okay? Okay, so for debt factoring, right now we did mention that this is without recourse, right? So, but when it's without recourse, you may need to think further, what does it represent, okay? So for debt factoring, without recourse means sales may affect business model and classification. So when a debt factoring without recourse, once you transfer out that risk and you de-recognize your financial asset, in substance, it is a sale, okay? So then the question is, what's your business model, right? Are you held to collect and sell? And if you do debt factoring, that sale, is it incidental or is it integral? Okay. So the extra consideration is it one-off sale, right? Do you happen to just only do that one time? You have some liquidity issue. Is it an insignificant amount or is it a significant amount? Then is it likely to be repeated? So maybe this is the first time, but you foresee that this is something that will happen in the future that may affect how you view your business model and what level were the sales, right? So more questions need to be asked because when it's without recourse, the substance of the sale, you need to check whether am I in first business model or second business model. Then it affects the accounting. So if it's with recourse, then it is no sale because at the end of the day, you will actually take back that risk, right? And for receivable, is you may actually still fall into the category of held to collect. Then more than one business model is possible depending on how the entity manage its finances lah. Okay, so possible that out of all its trade receivable, they have a pool of receivable that has been set aside for liquidity needs purposes, and they will want to sell it occasionally. So it's okay to have that in a group of trade receivable. Okay, now for unquoted shares. Entity E holds 10% shareholding in private entity, and these shares are held as a strategic long-term investment. So what are the possible measurement classification for the 10% shares held under IFRS 9? So just a hint, equity instrument will always fail SPPI tests. Okay. So why I gave you that hint, right, is because if you fail an SPPI test, you will never ever get to amortized cost. Okay, so equity instrument can never be carried at amortized cost. So for this case, you have two. Okay, so it could be fair value through profit or loss if you actually trade it, or you specifically designate it. Okay, then fair value through other comprehensive income because it's an equity shares and you are intending to hold it for strategic long-term investment when it's not for trading, then you can avail the one-time irrevocable election to account for it as fair value to OCI. So this is the debrief. For equity shares, is it investment held for trading? If yes, fair value to P&L. If not, is it elected to classify and measure the investment at fair value to OCI? So that is a one-time election. So all equity instrument is to be measured at fair value. That's a key message. So now we don't have costs already, okay? Unless very, very rare circumstance. So what is the key takeaway for classification of financial asset? Now, for all financial assets, including like trade receivable, okay, classification and measurement is determined by two things, the SPPI test and the business model assessment. Now, if you look at the nature of what SPPI is about, it is the contractual characteristic of the instrument in itself. And generally, once you've assessed it one time, you do not need to redo it because unless you modify the terms of your contract, that characteristic will not change. Now, but your business model, you can change your mind on how you run your operation. So a business model can vary. And that's where you may have potential reclassification from one category to another, and is triggered by a change in your business model. Okay, so maybe just to share later on, if you transit into IFRS, you have to do this, right, on the initial transition date. So you have to decide at that point of transition, what is the business model? So SPPI, you need to understand the contractual cash flow. So this one is where a lot of people tend to miss out certain things. Contracts are very thick sometimes, and wordings are not highlighted or bold or underlined unless it's very important, right? So things like suddenly I have option in relation to shares or tag to commodity price. These are things will fail the SPPI test. You have to look out for it, okay? And identify every potential cash flow that is within the terms and conditions of the contract. Because when you do your basic lending arrangement, you have to consider it holistically, right? So if you miss out a particular clause and it actually puts in a significant amount of item that is not like a normal basic lending, you will potentially classify it wrongly because the assessment is not done correct. So this is where in practice, the complexity comes in when it comes to applying IFRS 9, because you have to search for all these things in the contract, and your contracts are normally complex. So for business model, generally the assessment is required for each of the entity, because in the financial statement notes to account, right, there is always one part that talk about financial and risk management of the company. There will be a section in the notes to account that you need to tell the reader how you manage things like your liquidity risk, your market risk, interest rate risk, foreign currency risk. These are where the business model, you at least need to have one documented in your policy. Okay, then it may require judgment because economy is fluid, right? So the way we run our business is based on things may change in the economy. So whether or not you expect to do this in a long term or temporary, it may affect your business model test. Business model is impacted by sales, including transactions that lead to derecognition, example, debt factoring. So it's not necessary that it is very straightforward, that I say I sell it, right? I could just enter into a debt factoring or enter into any arrangement that in substance would trigger a derecognition. It could be a deemed sale. And that is where your business model gets affected. Then more than one business model is permitted. So this is really where the companies will have to sit down and assess how are they going to document the policy for all types of financial instruments that they have so that they will do the classification accordingly. Right? So there are some companies that prepare themselves to embark into IFRS 9 by having simulation to know what will be the potential financial statement impact if this is the potential business model. And then they put that in their policy based on what they think they are comfortable with eventually. Okay, for other financial assets, things like convertible loan investment, take note, will always fail SPPI test because convertibility is not basic lending arrangement. An equity instrument measured at fair value, okay, irrevocable election on initial recognition. So if you want to designate, you can designate to fair value to OCI, provided it is not for normal trading. You don't buy and sell the shares very frequently. Then, although allowed, but it's a very limited circumstance that it will be carried at cost. So you go back to the indicators earlier about when the cost would not be reflective of the fair value. So any questions for financial asset?
For the online participants, they have a questions. Continue to my question relating to SPPI alone with prepaid amount at 5%. We consider that whether 5% of prepaid fee is abnormal, not follow a basic lending agreement. Also under IFRS 9 have a clause relating to prepaid, and it tells if every fair value of prepaid feature is material, it can be considered as failed SPPI. In this case, fair value of prepaid feature is material. Thank you.
Okay, I believe this, the prepaid feature clause that you're mentioning is the recent amendment to IFRS 9. Clarified that if you have a prepaid feature in the instrument, it says does not necessarily fail SPPI. Okay, because it depends on this prepayment feature, what is the ultimate contractual cash flow impact over the overall financial instrument. If it is still within the normal range of a basic lending arrangement to compensate for certain loss and whatnot, they say you can still deem it as pass. Okay, but if you ask me, is 5% a lot? I cannot answer you because the standard never tell me what to tell you. The standard don't have percentages for me to tell you what to follow. So, but I would say this may not necessarily be assessed based on maturity of company, right? Because we have different concept. Maturity is financial statement as a whole. I believe the intention when we talk about whether this is significant is to the instrument. That instrument is it reflective of basic lending? Not whether 5% of this is material to the financial statement as a whole. It's different. Okay, so because we are looking at that instrument, you need to assess that prepayment feature. Does it affect that instrument to not meet the SPPI test? But 5% is material or not, I cannot answer you that one. It's a judgment call. Okay, so it's still back to the assessment of the overall instrument as it is. Okay, so I think another question was about the SPPI. Maybe the question earlier was relating to what if I don't have interest, right? So I will still go back to, even if you have like a short-term period that do not charge interest, it does not necessarily mean you'll fail the SPPI, because the nature of itself is that you don't even have time value of money, you know, the credit risk may be fairly low. So those like trade receivable will still pass SPPI test even though there's no interest payment, right? So even like intercompany balances, sometimes we do see that they actually do not charge the interest, but it does not necessarily mean that it will fail the SPPI test. But when you do the initial recognition, that's where you will have a day one gain or loss. Because between related party, I will do you a favor. I will give you non-interest bearing loan. But when you go to the bank, they won't give you without interest. So what happened to your fair value at initial recognition? You have a day one gain or loss. So that's where for intercompany, you may have a deemed equity contribution by your holding company, right? Because it's like an additional investment that the holding company pump to the company, right? So this is other consideration when it comes to related party. We will normally take a step back and look at the overall substance, because related party is always tend to be not at arm's length. Okay, so let's move on to liability. Okay, before I start, there's another question. Threshold use. So, okay, you're answering. Yeah, you can answer then. I'll continue. Okay, maybe just to share, in the IFRS 9, there is like illustrative example inside IFRS 9 to give you scenario when sales are being made. And they give an assessment of conclusion, whether this will fail or don't fail the sale test, right? So you can make reference to that lah. Okay, liability is I only have one slide because liability is a bit more straightforward. Okay, now for financial liability, there's only two ways to go about it. Amortized cost for all other financial liability, or fair value to P&L, specifically for held for trading, including derivative. Then if you want to initially designate at fair value to P&L, similarly like financial asset, you can do so, okay? So you either designate it, or if you're trading, fair value to P&L. Everything else becomes amortized cost. So this is fairly easier for us to classify the liability. Then if it is a designation of fair value option, we need to firstly measure at fair value. Any differences will go to the P&L. There is a specific criteria though on whether do you all go to P&L or sometimes it may go to OCI. So that circumstance is if I have a designation of a liability at fair value to P&L and there is a change in the fair value due to my own credit risk, then they say go to the OCI. Okay, so yesterday someone asked about what's the relationship between the credit risk and the fair value, right? So credit risk means the ability to settle. So if I have an increased risk of ability to pay my loan, the fair value will become lower. That means your liability becomes lower. It's a gain, right? It's a gain. They say you don't take that gain to P&L. It's to the OCI. Okay? In a way, they also don't want you to tamper with the profit or loss position on matters such as this, where it's a credit risk in relation to yourself and not transactional with the third party. Okay? Then all other fair value gain and loss will go to P&L. Now, if it goes through the OCI, this is clearly indicated that we do not recycle. So similarly, now and never will it ever go to the P&L. So when this happens, later if this is no longer relevant, it doesn't, disallow you to transfer among equity. So it only gives the instruction that you do not recycle to the P&L. Okay. Now let's look at modification. Okay, maybe I answer this online question. What does fair value option mean? It's referring to initial recognition designation to fair value to P&L. Okay, this is the same concept for financial asset. You have the initial recognition designation, financial asset, liability, you also have that. So, example, if you have a trade payable, normal, it will be amortized cost because it's not held for trading. But I want to designate as fair value to P&L. Can I do that? I can. But in practice, I never see it. Very rarely. Yeah, very rarely. Sorry? Yeah. And every financial year, you have to go and determine what is the fair value of that payable. Yeah. Okay. So for modification, okay, these few slides have a lot of numbers because I think we understand them better with computation, right? Now for modification, here I put is only liability. Reason being is because for financial asset, there is no specific mention or guidance given in the standard on how to deal with financial asset modification. But there was a Ifrs paper that discussed that we can use the principles in modification of financial liability to do the same for financial asset. Okay, so actually we can use this similar principle in practice for financial asset as well. Now for modification, the question to ask is it a substantial or non-substantial modification? Okay, now what is substantial? This is where IFRS 9 gives you a figure. It says 10% test. Okay, so they do give you a threshold here. So they say 10% cash flow test. If it exceeds 10%, it's substantial. If it's below 10%, then it is non-substantial. So what happens if it is substantial? Then the original financial liability will be de-recognized. So I will take it off, okay? Then if it's non-substantial, I will not de-recognize, but I will have to remeasure it. So this is the accounting implication on what I need to do. On the original financial liability, I will de-recognize based on the carrying amount at that point in time. Then for modified financial liability, which is the new terms, right? Because I modify it, I will recognize it as though it is a new financial liability instrument. Okay, then for non-substantial, I will need to remeasure. So I recalculate the carrying amount based on the modified cash flow using the original EIR. Okay, so this would have been the EIR that you determined earlier on your initial amount. Then, in both cases, you will see a P&L hit. The difference is, for the substantial modification, we call it a derecognition gain or loss. But for non-substantial, we just call it a modification gain or loss. So if I compare this with previous IAS 39, when there is non-substantial modification, they didn't have a P&L hit last time. After they introduced IFRS 9, modification with non-substantial modification will also trigger a gain or loss in the P&L. So costs or fees that are incurred in the modification arrangement. So if it's substantial, the costs or fees are generally accounted for as part of the derecognition gain or loss. But for non-substantial, any cost or fee is adjusted to the new carrying amount of the financial liability and will be amortized over the remaining term of the modified liability. Now, the question would be, when do I do my modification, right? So for accounting, timing is always important. When is that adjustment needed? So modification date is the date when both parties has come to an agreement that these terms are modified, right? So for instance, if you are still in negotiation stage, you haven't agreed yet, you still do not effect the modification yet. So typically, it will be when both parties sign and date the contract. Then that date onwards becomes modification. So modification could be any time, right? So if you sign it, say on 3rd of February, then on 3rd of February is the date that you remeasure. Okay, so you generally don't do just because it's at the end of financial period, but one may argue that it may not be material, right? But technically, modification date is the date you do your calculation. Okay, another thing to take note is modification is very specific. If there are changes in the cash flow based on the original term of the contract, they are not considered modification. Modification can only happen when the original term of the contract has been modified. Okay, so for instance, if we have clause like due to disaster, right, that you need to pay immediately arising from war, let's say, okay, and it was in the original contract. So in the times of peace, we would have computed our liability as an X amount. Then war happened and the cash flow now has to change. That is not modification. Why? Because my original contract already have this clause that say you need to do so. Okay? Now, if your contract earlier was silent, and now I come into the picture and say supplemental agreement or other document to say that this contract, now I want to introduce a new term. That is modification. So long as the terms and condition was non-existent in the original contract, then that would be the modification. Now, we also mentioned in the standard that sometimes a modification does not necessarily need to give rise to a direct and immediate cash flow impact. right? So you might not require to change the cash flow in the next 12 months, but the terms and conditions that you modify may kick in later, like let's say in year 2 or 3, right? So it is still a modification, although we don't expect to have a change immediately. Okay, I hope you all can see this. It's quite small. So this is one illustrative example, how I compute the 10% test and then conclude whether is it substantial or non-substantial. And then how do I account for it? Okay, so this is the fact pattern, top left. So this one is to talk about non-substantial. So the company entered into a fixed rate borrowing with the bank on January 20X2. The terms of the borrowing before and after the modification, the salient terms are here. Before, the amount nominal is 100. This was a 9-year loan. There is an interest rate of 4%. And based on my amortized table, my EIR was 4.69. I incurred a transaction fee of 5. And upon modification, I have increased my notional amount to 110. I prolonged my duration to 11 years. My interest rate has reduced by 0.5%. And based on a new revised term, I would have an EIR of 4.84. And at that time, when I modify, I had to incur a transaction fee of 1. Okay, then take note a bit of an additional information. The date of modification is 1st Jan 20X5. Okay, so these terms were introduced in 20X5, which is 2 years after the start of 20X2. Then the company also received 10 and the notional amount increased by 10. Okay, so this 10 is basically I pay to actually to introduce the modification, right? So sometimes there could be certain amount or what we call like premium. I don't want to use the term premium because premium is very specific in IFRS 9, but this could be an amount that was paid in order to allow for this modification. So this 10 was received. And then directly attributable transaction fee to third parties. We are saying the transaction fees are all directly attributable. So these are transaction costs. So if I were to do a amortization for my original loan, this is how it will look like. Okay, so I didn't plot 9 years because I don't have space. So I will show you year 2, 3, 4, 5, right? And why I stop at 5 is because I want to show you that on the opening of 1st Jan 20X5, which is so happened to be my modification date, my carrying amount was 96.44. Okay, after I do my computation table. So this was my interest. So my interest here is based on the original EIR, and I had to pay 4%, right? So 4% of 100 is 4. Then I need to settle the loan by paying the interest for the last year and also the original notional amount. That would have been my 0 at the end. But I modify it. So when I modify it, I need to know if it's substantial or non-substantial. So I have what we call the 10% test. So what I need to do is I plot every single cash flow of the modified term. So I will have this 10 that I receive on modification. This is the cash flow that I need to pay for my loan, which is 3.5 at 100 at 10 for the remaining period. Then this is the amount that I need to pay the principal of 110. And the total cash flow is summarized all here, this column. and I do a EIR computation, right? So I use the original PV factor. So the 10% test, they say, test it using original EIR. So use 4.69, okay? Not 4.84, it's original one. Then this is my expected net present value of the new liability discounted at original EIR is 91. Okay, so basically I'm trying to establish what should have been the amount now based on original EIR. So when I compare 91 and 96 is 5.04. So I convert it into a percentage. 5.04 divided by 96.44 is 5.2%. So it becomes less than 10. Non-substantial. Okay? So if it's non-substantial, I don't de-recognize. So I remeasure. So this is how I will remeasure. From 9644 as of 1st Jan 20X5, I will add the cash that I receive of 10. I will flush to the P&L the modification gain or loss, which is actually the 5.04. And the transaction fee also, I pick it up. So if I go back to the guidance here, it will say gain or loss, modification gain or loss, I need to pick up. My 10% test, I was testing using the original EIR. And then my cost of fees that I incurred, which is the 1, I must adjust to the new carrying amount. That's why I adjust it. Here is new carrying amount. So this is my new carrying amount after I modify my loan. Then from there on, I continue my amortized costs. But I will continue on using new EIR now. Okay, so this becomes my starting point here from 20x5 for the remaining years that will end after the 11 years since it's original. Then I have the new figure. This is my new carrying amount for every year. And then by the end of the year, I will fully settle my loan. Okay. Now the same fact pattern, I change my modification a bit so that I trigger a substantial. So similarly, I have the original loan as it is. When I modify, I change the major part is interest rate. So instead of 3.5, I put my interest rate is 2.5. Okay. Now, before the modification, same table, 10% test. Now I plot the new figures. I got the 10, interest at 2.5, principal amount of 110. I present value based on original EIR is 84.2. This difference is 12.24, and it gives rise to 12.7%, which is more than 10%. So when it's more than 10%, this I will be considered as a substantial modification. And I will need to de-recognize my original loan and recognize a new loan based on the new term. This is how I do it. So my carrying amount before modification was the original 96. Then I will add the cash on the modification of 10. This difference is what I call the gain and loss arising from the derecognition. And at the same time, if I go back to this table, it says transaction costs related to substantial modification also part of gain and loss on derecognition. That's why I have the 1 here. So all in net, loss on derecognition is 4.56. So if I look at double entry, right, this will be P&L. 96 will derecognize and re-recognize 110. Okay, so you will actually debit 96, credit back 110. Then you will also have the 10 from the cash on modification. Okay, so this is for modification. Now, we can do the same for receivable as well, like loan receivable. Okay, so maybe I want to share a little bit. In Malaysia, during the COVID, we had the authority issued a document to say that for FDI, the banks, they provide the moratorium to the end customers, right? So it's supposed to be a modification, technically speaking, because everyone's loan was as usual. And then when COVID happened, the banks so-called modify it by telling you you don't have to pay for the next 6 months. And this was not in the original contract. So if I apply IFRS 9, this would trigger a modification. And in either case of the modification, I will have a P&L gain or loss hit. But this will affect the banks very badly. So they say, temporarily, during 3 years, you do it in OCI. So what happened is, I have this year, OCI, next year, OCI, comparative OCI, until the effect after 3 years have been washed out, I come back to IFRS 9. So the impact gets washed out. Okay, so what is the implication for the accounts? It will be non-IFRS compliant for that period, for that 3 years. Okay, so that was something that happened in COVID that was specific to FDIs. Okay, any questions? Okay, so I touched a bit on reclassification. Now, for financial asset, because I have a few categories, right? I may have reclassification from one category to another. So, reclassification, the expectation is that it should not be frequent. Okay? And the changes must be significant to the entity's operation. Okay? So you don't just change whenever something small happens, right? It needs to be something that is quite significant to the company's operation that would trigger a change in reclassification. So earlier I mentioned, right, SPPI is a fixed characteristic of the instrument. So the only way things will change is if you change your business model. So when the change in business model, that is why they say it must be significant to your operation and not just some temporary change, okay? So example of changes could be maybe you acquire new instrument or acquire new business and you are changing the way you manage your finances. Or any major disposals, okay? Like maybe you dispose of a cash cow in the group and now you have to re-look into your business model. Then termination of business line, right? So these are all very much restructuring based, are significant events. Okay, now changes would not include change of intention relating to particular asset. Temporary disappearance of a particular market for financial asset, or transfers of financial assets between parts of the business with different model. Okay, these are not considered as reclassification. Thirdly, the changes must be demonstrable to external party. So it cannot be something that only internally we know, right? The expectation is that an external party will be able to see a difference, or if you have made any declaration that a business model has changed, for example, right? Then that must be demonstrable to external party. And it's not, technically, it's not necessarily referring to just readers of financial statement, it's stakeholders, right? So perhaps even your bankers and whatnot, when they present their business plan for obtaining, let's say, a new loan, and there is a change in business model, it is demonstrable to them. Then prospective, but only applied once the business model has changed. Okay, so changing a business model may not be something that is very simple, and it may take some time. So in the process of changing, it might take a while until it change. Then only you account for that change accordingly, right? So it does say it's a forward-looking thing, meaning you don't go back and restate, because as you run your operation, it's fluid, so it's a forward-looking. So once there's a true change, an actual change, then you account for it. And the expectation, because the business model is expected to be set by key management, any changes to it is also expected to be determined by senior management following the internal or any external change that affects how you run your operation. Okay, so this is how we account for reclassification when it happens. So we have three categories: amortized cost, fair value to P&L, fair value to OCI. So this we'll talk about if it's amortized cost to fair value to P&L or amortized cost to fair value to OCI. And same goes for the other category. So you will see 6 of this. So firstly, if it's amortized cost to fair value to OCI. So when would that happen? When SPPI test is met, but I suddenly now decide that I want to held to collect and sell. Okay? Then, because the new category is at fair value, when I do the change, I will have to identify what is the fair value and recognize it at fair value. Okay? So that also means that carrying amount as of the financial year for the amortized cost is not deemed fair value. No such thing. Okay? You have to identify the fair value for you to do the initial recognition on the new classification. So any differences between this carrying amount and that fair value, because this is an OCI category, it also goes to the OCI. And for fair value to OCI, because it is a SPPI characteristic test met, you have that instruments like with effective interest rate. So OCI have an EIR. Amortized costs also have an EIR. They are saying this EIR, you follow the amortized cost EIR. Because the instrument did not modify, you only change your mind on what you want to do with it. It's just a business model change. Okay, next we have fair value to OCI to amortized costs. So when would that happen? If last time I used to held to collect and sell, now I decided I don't want to sell anymore. I just want to held to collect. So because amortized costs will be cost-based, right? Your fair value as of the closing fair value of the instrument plus any amount that you have already accumulated in the OCI become your deemed starting point for your amortized cost. No adjustment for EIR because both of these instruments has EIR and you will retain it as it is. Then only impact the OCI. So because originally it was the OCI, it will only impact the OCI and not the P&L. Thirdly, if it's fair value to OCI to fair value to P&L, so the only thing that changes is where do you park the fair value difference. It is still at fair value. Okay, now you need to take note of this little call out box here. The reclassification is not allowed if it is an equity instrument that was designated at fair value to OCI. Okay, so you remember anything that you designated at start, you cannot change your mind. So a reclassification will never ever happen. Okay? So for fair value to OCI to fair value to P&L, because the designation one I cannot change, what is left here is those that was SPPI test met and held to collect and sell. And I decide that it will go to P&L. Let's say I held for trading, for example, then it must go to fair value to P&L. So because it's at fair value, then it continue as fair value. Then for IS1 reclassification, this is what we call the recycling effect. Okay, so the adjustment of the cumulative amount in the OCI will now recycle and flush to the P&L. Okay? Okay, now another one is amortized cost to fair value to P&L. So because the new category is fair value, I will have to identify the fair value and book it at fair value. So any difference between the carrying amount and the fair value, because it's a fair value to P&L, that difference will go to P&L as well. Then, if it's a fair value to fair value to P&L to an amortized cost, then closing fair value becomes the new amortized cost opening gross carrying amount. So this one become the deemed cost, right? And because fair value don't have EIR back then, you don't have such a concept, I have to now identify what will be the new EIR and measure ECL because amortized cost financial asset will be subject to ECL. So maybe I didn't explain earlier. So when would this happen? Amortized cost to fair value to P&L could be that from held to collect to I don't know what I want to do with it. Then it becomes other category, fair value to P&L. Now for fair value to P&L to amortized cost could be I didn't know what I want to do with it. Now I know what I want to do with it. I want to collect. Okay? So in business, it can happen. It can happen, okay? Okay, last one. Sorry? Huh? Okay, okay. Last one, because lunchtime already, right? Fair value to P&L to fair value to OCI. Okay, again, here we want to highlight, if you designated it at fair value to P&L at the start, you cannot change your mind. So you cannot suddenly designate and then I want to change to OCI. So continue to measure at fair value since both of it is at fair value. But fair value to OCI, in this category, we are not talking about the equity designation. Yeah? So we are talking about business model number 2 with an SPPI test met. So I will need to have a new EIR. And fair value to OCI category is subject to impairment. So I will also now consider ECL. So when does this happen? So for those that I didn't know what I want to do with it, now I know what I want to do, which is held to collect and sell. Okay, so there are many probability, right? Because we have three category, so you will have 6 different probability here. So the key takeaway, financial liability that is designated at fair value to P&L, any gains and losses will go to P&L, except for those that is related to your own credit risk, that gain goes to OCI. Then non-substantial modification of the financial liability, gain and loss recognized at the date of modification, and amortized cost is recalculated. So in either case, right, whenever there's a modification, we should expect to see some form of P&L flushing, okay? So it's not the same as IAS 39 anymore. Last time, we only remeasure. Now, reclassification permitted for financial asset only when the business model has changed. Intending to change is not good enough because you do not demonstrate that actual change to the external party, right? And financial liability, why I don't have that? Because it's not allowed. So it becomes fairly simple, right? I don't even have to consider fair value to P&L to amortize cost for liability at all. Okay, so I think we will break for lunch, then we come back for ECL.
Kính thưa các anh chị, buổi đào tạo sáng nay chúng ta sẽ tạm dừng tại đây và sẽ trở lại vào lúc 13:30.
Recording stopped.
You have any, right? Just go grab some food.